Investors are watching the House of Representatives as it prepares to vote on President Trump's megabill while also awaiting the June jobs report. Let's bring in Drew Matus, head of the Global Economic and Market Strategy team at MetLife Investment Management. Drew, great to have you with us. First, because they're discussing it as we speak in Congress, the bill, how important is that to your overall market outlook for later this year in terms of getting those tax cuts extended?
Well, without the tax cuts being extended, we would have been in a real mess. So despite, some of the issues that you might have with the bill in terms of the size of the spending, what it does for deficits, if it didn't get passed, it would probably be worse.
Right. So it doesn't matter what from an investor standpoint, at a high level, look at the markets, it doesn't necessarily matter what the details of the bill are.
It's more about the extension of the past tax cuts. If you remove the extension of the tax cuts and you had a big tax increase, it's just not something the economy needs right now.
Okay. I want to get to jobs because your forecast is low. You think it could be less than 50,000 for the month, and that would really signal that the Fed cut could be in play for July, I would think.
Well, we don't have them cutting in July, but in terms of the forecast, I just want to be clear. So I'm also including the net number, right? So I'm including the revisions to the prior 2 months, which have been significant in the past couple of months. In fact, everyone was so upset by last month's ADP report, which was 40. And then at the end of the day, we basically got 40,000 jobs, and everyone liked the payroll report. So there is this disconnect in the market where, one is a little bit of whistling past the graveyard. Like, things have turned south and things are deteriorating, and everyone seems to be willfully ignorant of the fact.
Is it ignorant or happy that the Fed would step in sooner and cut sooner if things are going south?
Well, so there's the interesting thing. The Fed really can't cut until they see solid evidence of weakening. And that means the unemployment rate needs to move higher. Without the unemployment rate moving higher, Powell's just kind of stuck because inflation is still a little too high. And the absolute worst thing the Fed could do is cut the Fed funds rate and have the 10-year yield move higher.
Mm-hmm. So when you say the unemployment rate has to move higher, by how much? Like, what sort of orders of magnitude? It is supposed to tick higher in this month.
Yeah, so that, our view is that they kind of need to be moving directionally towards 5. Mm-hmm. Once they breach 4.5, they're probably in the clear for a cut, and that lines up a September rate cut.
So when investors are hand-wringing over sub 50, over 50 for this month, that's really not what we should be watching in terms of unemployment as a trigger for the Fed. It should be the rate, and it should be meaningfully higher.
It should be the rate. It should be meaningfully higher. And you also, there's this debate about soft versus hard data. The survey data is all telling you that when people go into the office, that they are feeling something in the office that's not quite right. Right? And so everyone's becoming more pessimistic about the labor market going forward. And that pessimism can actually become self-fulfilling because as everyone feels more worried, they begin to save money because they're like, wow, I don't know, my boss kind of wouldn't talk to me, wouldn't look me in the eye. So maybe I'm in danger. And then they think to themselves, maybe I'll just kind of cut back on something so I can put a little more money aside so I'm safer.
Mm-hmm. Overlay the tariff situation here in terms of the psyche of CEOs. I would think that even if things, if things don't get resolved and there's sort of this uncertainty and it's prolonged, that would cause them, even if their business were operating fine right now, that would cause sort of a pause in investing, a pause in hiring, which has trickle effects.
Well, absolutely. It's hard to make an investment decision when you don't know what your return on investment is going to be. Right? So how do you make that decision? And if you pick country A instead of country B, but then all of a sudden country B has a higher tariff rate because the tariff rates are moving around, then you've just wasted a lot of money, time, effort, and energy. But that kind of relates back to the labor market, right? People are like, why haven't there been a lot of layoffs? Well, layoffs take a lot of time to plan for, right? In large organizations, if NBC was going to do layoffs, right, there would be a whole planning process. It would take months for them to figure out who they want to lay off.
We're not out of the clear, Drew.
No one's ever in the clear.
That's true. In terms of the markets, it sounds like you are cautious then for the rest of the year, that there are plenty of reasons to maybe think that we're fully valued here at highs.
I will say this, the equity market makes less sense to me at these valuations than does parts of the fixed income market or things that are more related to, there's a reason that firms like mine like private credit and and the like. And it's because you can get a lot more protection built into the system and a lot more covenants and things like that that protect you in the event of a downturn. And you can pick up yield because you're giving up liquidity. And so that's a really great kind of opportunity for firms like mine. But for people who are in equities, it's probably a time to be a little more cautious.
You mentioned fixed income, which is interesting because I would think that with, the talk about the tax and spending bill, that there'd be some concerns around fixed income given the issuance that will need to come to pay for everything. And so what is your outlook here with rates? We see the 10-year at 4.26 or so, which sort of is kind of amazing if you think about it. I mean, we started the year at, 4.8% or something like that? Or I think May we started.
Yeah, so our forecast for year-end was 4.25. We're leaving it there. We kind of expected that, over time, economic fundamentals dominate. And for all the talk about there being a huge budget blowout in this bill, yields are lower today, dollars higher today, because people don't care. They like because they like to care.
Hold on, but if they don't care, then what have we been debating the whole time?
There are a lot of people who like to go out there and say, oh, it's the end of the world, weeping, wailing, gnashing of teeth. And the reality of it is, yes, it's a few $1 trillion, but if you think about other things that are occurring in the economy, if AI is as productivity enhancing as people might believe it to be, right? And you just had Dan Ives on.
So just to be clear, your argument, though, is that ultimately, therefore, you think that this bill won't cost $3.8 trillion or $3.3 trillion or anything. I assume you think it'll be beneficial. Is that what you're suggesting? Which by the way, may be the case.
My argument is that temporarily it keeps us from having a sharp downturn because it extends the tax cuts. You're going to have more deficit spending, which I don't necessarily like. But is it going to cause the collapse of the U.S. financial system and the dollar? No, it's not. And I think, while we need to get our house in order, the last time we had the amount of revenue being directed towards interest payments that we have today, 5 years later, I was writing about how the Federal Reserve could conduct monetary policy without U.S. Treasuries because there were so few U.S. Treasuries on the street that we had to be rethinking how we might conduct monetary policy. So it's all solvable.
Your ears perked up because so many guests come on railing against the deficit and deficit
railing
spending,
against the deficit, say the dollar is going to go to hell.
Has been going on for decades.
No, I know, but then you get into.
Years.
By the way, then we had the other argument, which was this sort of MMT argument, which I also thought was crazy.
Yeah.
And maybe they're on both two ends of the spectrum.
But the trick of it is you want to grow your way out of this. Right?
Oh, you're going to have to grow your way out of it.
But you never want to actually pay down debt. You actually just want to grow your way out of the debt and make it a smaller percentage of GDP. And so do we have that opportunity going forward? I suspect that we will. I suspect we'll actually be forced into it to some degree because we are crowding out private investment. I mean, that is happening with this. But in terms of kind of short-term, medium-term, long-term, we solved the short-term issue, which is avoiding a massive tax increase. The medium-term, there's some negative stuff. But longer-term, if it keeps the economy on an even keel or a more even keel than otherwise would be.
One of the questions just about the debt is, you could go back to the first administration when we passed this bill the first time. And you can say COVID made things tougher. But even before COVID was around, it wasn't as if somehow the growth was so outpacing everything that we were able to pay things down. Like, that did not happen. We continued to increase our deficit. It's just the truth.
That is the truth. But
so if you're growing and have if you're growing with the deficit constantly, that obviously should be considered unsustainable. And
that points to actually the true problem, which is a spending problem, right?
I'm not disagreeing with you either, but I'm just saying this is the life we've chosen.
Yes, it's the life we've chosen, and politics are what politics are, and eventually, but history has shown that you can get to the right place, right? We got to the right place in the mid-1990s. We were actually doing quite well, and actually then what derailed us was actually September 11th, right? So, so there will be another time where we can kind of revisit things and think about how things should be structured. And it might be during the middle of a large productivity cycle that's boosting potential growth significantly higher and containing inflation at the same time and leading to kind of something that looks like the mid-1990s from kind of a revenue standpoint and others.